Good day friends, CEV Group welcome you for watching this video. Please do not forget to like, comment and subscribe our registered values club for getting all new professional updates. So in this video we will discuss certain special case studies. There will be three case studies which are specially designed case studies. First one is salt manufacturing facility, in which we will discuss how to calculate the value of a salt manufacturing unit. Then we will discuss one economically obsolete industrial unit, that how to you can find out the value of economically obsolete industrial units. And third one is valuation of a drive-in cinema. So these case studies are based upon income approach. So income approach, there are two things which you can do. First one is you calculate the net gross income of the property or from the business which is being done in that property. From that gross income you will deduct the outgoings or expenditures to calculate the net income or net profit, and then this net income or net profit will be multiplied with the year's purchase, from where you will get the capitalized value of the property. So we will discuss all these three case studies based upon the net this income approach method. First one is valuation of salt manufacturing facility. So what is salt manufacturing facility? We will discuss first of all. The recovery of salt from the sea water is a technical process, and ideal site is proper coastline. During high tides, water is stored in specially prepared ditches with the help of properly laid electrical lines, pump sets, well, etc. The leveling of the land for the production of salt is very important, and hence the earthwork involves substantial expenditure. The seawater thus stored is circulated in different compartments to the density and degree of salt obtained by evaporation. The manufacturing process of salt mainly depends on climatic conditions. The heat of sun is very important for seawater evaporation. During monsoon, the manufacturing process of salt comes to a halt, and there is also a loss of about 20 to 25% of the salt already stored. So this is an important thing. So at least for the 2 months of in a year, the salt manufacturing has to be stopped, has to come to an halt. So only 10 months are there in which you can manufacture this salt. So when you are doing valuation, what you will do, first of all you will calculate that how much quantity can be produced from how much quantity of salt can be produced. First thing is you calculate the quantity of salt, and then you rate of salt at which can be sold will be given to you. You multiply this quantity with the rate, that will give you gross income. And this gross income, from this gross income, you will deduct the expenditure, and this will give you net income or net profits. So you will multiply this net profit with net income with YP, that will give you capitalized value of the property. The same thing which you have been applying in income approach method, that will be applied here, there will not be any difference. So first we will discuss the problem which is given to you. You have to prepare the valuation report of a property which is in the form of an open plot of land at Kandlapur, district Kutch, Gujarat. The location of property and the reference is, is prominent with respect to a salt manufacturing unit. It is situated at a distance of 5 kilometers from the main city of Gandhidham town and is linked up with the railway station and highway by all weather Pakka roads. The problem of rain is also not serious as this is a desert area and the monsoon is likely to occur for 1 or at the most 2 months in a year. The area of the land is 300 hectares and it is being used for manufacturing of salt. The owner of the has taken the property on permanent lease from the lesser Kandla port. So it means Kandla port is lesser in this case and the owner is lessee with an annual ground rent of 3 crore 75 lakh. So it is also given that the effective period of production is 10 months in a year. Average production of salt is 35 ton. This is average production of salt per hectare of land per month. Sale price of the salt 1400 to 2500 per ton. Average expenses per ton 350 to 600 per ton. So see in this question you have nothing to do with this part that this is a near Gandhidham desert area, otherwise other things are it is away from 5 kilometers from the main city of Gandhidham. The main thing which you have to consider is the data, this data, and this these things, area of the land, ground rent, and this data. This is important from your calculation point of view. So what you will do? First of all, you know average production per salt per month per hectare is 35 ton and total area of the land is 300. So how much a salt can be produced per month? It will be 35 into 300, 300 hectares of land. So this will be the amount of salt which can be produced per month. But in a year, you know, 2 months will be wasted during monsoon in which no salt can be manufactured. So, number of months in a year which will be in which the salt can be produced that will be 35 ton into 300 into 10. This much of the salt can be produced in a year. So you know in the case of income approach method you have to do all the calculation annually. So next this is a salt price. So this is the salt price per unit or per ton you can say. So you can calculate its average. You can calculate its average which will be 1400 plus 2500 divided by 2. That will give you the average price of the salt per ton. Similarly, you can calculate the expenditure. You will take the average of 350 and 600. That will give you average expenditure. So from the income, average income, you will calculate the average expenditure. That will give you net income per ton. So net income per ton you can calculate this way, and total production is known to you. This is total production. You can calculate the total net profit from this data, and we will convert this net income or net profit into capitalized value by multiplying it with YP. So this is given that we will be using this profit method from the business. You calculate the average sale price. Average sale price, 1400 plus 2500 divided by 2. So average sale price is 1950 per ton. And average salt expenses, that is 350 plus 600 divided by 2, rupees 475 is the average expenditure. So net income per ton will be 14,547. So average production we have already discussed, it will be 300 into 35 into 10, 1,05,000 ton. So you multiply net income, net profit from the salt with the total production. So that will give you the annual profit, which is 15 crore 48 lakh 75,000. And we assume the capitalized value at 12%, you can calculate. You multiply net profit with YP, 100 upon 12, that will be YP. YP will be 100 upon 12, which will be 8.33. So you multiply with the net profit with 8.33, that will give you the value of the property 1 crore 29 lakh 129 crore 1 lakh 8,750. But another thing is given that the owner has taken this property on lease and he is paying it lease rent of 3 crore 75 lakhs. So you have to deduct the value of this 3 crore 75 lakh from this value so as to get the net value of the property. So total ground rent is 3 crore 75 lakh per month. You calculate its value of 3 crore 75 lakh at 5%, which gives you YP equals to 20. So in this way, you can calculate the total amount to be deducted YP into 3 crore 75 lakh, that is 75 crore. So net value of the property 120 crore 91 lakh 8,750 minus 75 crore. So net value of the property is 54 crore 1 lakh 8,750. So in this way you can calculate the value of the salt manufacturing unit. So there is nothing new in this. Just you have to calculate the value net profit, and from this uh, net profit you calculate the capitalized value of the property. Then next case study is valuation of economically obsolete industrial unit. So there are certain rare type of property which will come in the market for sale, and as it is functioning as an industrial unit, it will have to respect all the prevailing laws framed by the government from time to time. The machineries are firmly fixed to the floor, and as per prevailing rules and regulation of government, they can neither be scrapped nor their working can be stopped. So this is most important. They can neither be scrapped nor their working can be stopped. So in this case, you have to consider following two factors when you have to do valuation of such type of property. The structures, even if they collapse, will have to be erected again, even though the return on the investment on them may not be available as per the other investments. Hence, actually, what is happening is that very low return on investment is available in this type of property due to forcible running up of the unit even on uneconomic lines. So hence in this case, the structure and land may give you high return for other purposes or giving low return for this particular purpose. So there is economic obsolescence of the structures and land compared to their use for other lucrative purposes. So loss in value for future satisfying services due to age has to be considered. So these are the two things. One thing, economic obsolescence of land and building. That is most important thing, which we will be discussing how you will be calculate the economic obsolescence of land and building as compared to other lucrative purposes. And how it can be done, we will discuss in this example. I think all the things will be clear to you. If you have any doubt, you can ask in the comment box. Thank you for watching this video. Please like, comment, and subscribe. Have a nice day. Thank you very much.